Hey guys, what's going on? My name is James Mason. In this video, we're going to talk about how much you should trade with, position sizes, and averaging up or down. So, how much should you trade with? Well, that's really going to depend on you as the trader. You should never trade more money than you are willing to lose. Basically, if you can't take the money in your portfolio and throw it out the window and it not affect you in your life, you don't need to be trading it. You should never trade money that you need to pay bills with, and you should never think that you're going to take this money and you're going to flip it and make more money to make your life easier, because it doesn't work that way, especially if you're just starting. Also, if you take money that you need in life, that you actually need, like as in like you need it to pay bills or whatever it is, you have emotions attached to that money, and you ain't going to be able to trade that anyways. You will screw up and lose probably most of it, if not all of it. So only trade money that you're okay with not ever seeing again in your life. That's the expectation you need to have. Now, let's just say you're starting off with $1,000. The best way that I would say to trade $1,000 is really penny stocks that are uptrending, that have a catalyst behind it with hype. And in one of the further videos, I actually showed the stock scanner that I use to find these. And I like to use the Bollinger Bands, but at different times, just depending on what I'm looking for, I'll use my EMA lines with a VWAP and all the other stuff. So, find that video, check it out for that scanner, and paper trade with it. See how it works for you. Well, actually, if you set it up the way I have it, I know how it's going to work for you. And just see for yourself how some of these stocks work and how they move. So let's just say you have $1,000 and you decide to trade penny stocks. Well, a lot of people are drawn to buying penny stocks that are taking a huge dip, and they basically got their information off the internet in a forum or something like that, or someone told them that this is going to skyrocket to whatever price. And truth be told, when a lot of penny stocks start to take a hard dip, if they ever rebound, it's usually never to where they started at the dip. If you don't want to take my word for it, go back and look at the history on the 1-day, 1-year charts for a lot of these penny stocks. So, you have $1,000, you decide to buy in a penny stock. We'll just use ticker LGEN. I actually called this out on the watch list the other day. I called it out on July 3rd, so the next trading day would have been July 5th. Let's just say, if you would have took your money and invested it into this right here at the opening, right here where it peaked the other day, that is actually just a little over 10%. Now, with my scanner, this isn't for long holds. I'm not an investor. I trade to make money. And if you are a trader, that's how you should be as well. If you want to be an investor, then you need to do your own due diligence and find whatever stocks that you feel would have the potential to make money in the long run and go about it that way. For the investor stuff, I can't help you with that, I'll be honest. But for trading, I can show you how it works. So you have $1,000. What you should do is you should never dump your whole portfolio into one stock, because if that stock tanks, that's just a deeper hole that you have to dig to get out of. So if you would have used $500 and bought in, at this point you would have made $50 in technically 2 days. I know this says 4 days, but you got to think the holiday and, you know, let's see, I guess the weekend or whatever. But you made $50 in a swing trade. Now, a lot of people are probably sitting there thinking, man, $50 is crap. That's not enough money. Those that are thinking that, you are destined to lose a lot of money in the future. I'm just going to be honest with you. Because when you only are trading with $500, $50 in profit is pretty daggone good. 10%, you can't complain with making 10%. Because if you was trading a larger cap stock with $500, let's just say Tesla, that's over $300 a share. You're going to get one share, and if you hit it just right, yeah, you might make 50 bucks off of that one share. But what if you don't hit it just right? So, you know, that's how you got to look at it. Trading penny stocks versus trading large cap stocks. Penny stocks, you trade them in percentages. Large cap stocks, you trade them in dollars. So, off of a $500 position, $50, 10% profit, sell it, walk away. Because if you keep making trades like that, and let's just say your other $500 you put in a second trade, and you make 10%, you made $100 combined. And if you hit these stocks to where you're making this 10% pretty consistently, that $100 between two trades, that builds up, and it builds up pretty daggone quick. So don't ever put all your money into one stock to trade it. Only trade upward trending stocks, and never trade money that you need in life. So let's look at Tesla real quick. Alright. So let's just say that you decided to, you know, we'll just say you didn't trade it off of the Bollinger Bands when it broke past here and rode it up. But you bought it right here when it bounced off of this lower band. And this is actually how a lot of people trade with the Bollinger Bands. You know, with me, I do it once in a while, but when I actually do this, it's only with quality stocks like Tesla, higher cap stocks, because they are usually more consistent and usually more forgiving than a penny stock, because a penny stock can bounce on this thing, start coming up, and then just shoot down. And there's a reason why they're penny stocks for the most part. Now, look at Tesla. let's just say you made the right call and you bought it right here at the actual bottom of this candlestick. You bought it right there and you waited, just a few days, and you sold right there. So you bought one share with $500, and 3 days later, if you look at the percentage, that's just 6.5%. So the percentage is, it's okay. But look at the dollars, $19.76. That is pretty good, but you only have one share. And so, what you got to take into consideration your commission fees, things like that. And if you're using Thinkorswim, your commission fees, if you haven't negotiated them down, and have a video on negotiating them down, if you haven't negotiated them down, they're $6.95 per buy and per sell. So almost $14 for a complete trade. So you'd have to minus $14 out of that $19.76. And you basically only made $5 profit. That's not worth it. So when you build up your portfolio, that's when you should actually start trading these larger cap stocks. And when you get it to where you can buy like 10 shares or more, that's when it will start working out great for you. So let's talk about averaging up or down. In the penny stocks, we'll go back to LGEN. Let's say you bought back here, and we'll just say you bought thinking it was going to bounce off of this line and continue upward. You bought right here, and then it goes down to right here the next day. You're now 16% in the hole, and then the next day that's 22%, and over here a couple more days later it goes back up. You're only right at 10% in the hole, but then it goes down. Now you're 24%, and then you eventually get way over here and you're 36%. Now if you'd have bought right here with the idea of, well, just because this is cheap, I'll just keep averaging down. So let's just say, I don't know, you bought $500 worth of shares right here at 0.0107, and then you decided to buy more right down here because it bounced off this line. This is 0.0083. So now your average is going to be like 0.009 something. So you're basically sitting right here where my crosshairs are for your average. So even though you average down over here, your average sits like right in here. So you are still red. Now, as it eventually goes up, you break across, your average, and you're making a little bit of profit here. Not much. But then it goes back down. And so, let's see, I was at 0.0095. So now, look at the difference from right here to right here. I started at your average. At this point, you're still minus 26% negative. And now you have added more money over here, so your losses are magnitude more. So that's why with penny stocks, it's never good to average down. Now you can average up, but usually these runs with penny stocks are short-lived. And I'm just going to be honest with you on that. They're short-lived. You need to take your profits and walk away. 99% of these do not hit dollars like everybody hopes. I'm sorry, but it's just not the way it is. And, you know, I wish it was that way, but that's just not the reality of it. So, to be honest with you, and you don't have to listen to me, but you'll figure it out. Averaging down on a penny stock is not a good idea because you just increase the bag you're holding. Now, let's go up and we'll talk about a quality stock. We'll go back to Tesla. Let's just say you watched this and you thought it was going to bounce off of this EMA line right here, and your intentions were to catch it right there and ride it up to the top of this line right here. That would have been great. You would have been up $32 per share, but it didn't work out that way. Instead, the next day, because this is a one-day chart, it went down $30 the next day. Well, at this point, you're like, dang, like, I wished that either I would have waited a day, but hindsight is always 20/20, or you're probably saying, I wish I would have just sold off sooner, you know, put in a stop loss, but let's just say you didn't. Well, on a quality stock, and this only works with quality stocks, you could actually average down right here. So you bought in right here at $340.08. And down here, you decide to buy in, you know, at this low point, $309.77. So for easy math, we'll just round those to the lowest dollar. So up here, 340, and down there, 309. So up here, you buy, I don't know, we'll just say one share. So your average is $340. And then down here, you have the money, you decide to buy another share. So the difference of this is, you know, $31. Well, we'll just say $30. So divide that in half, you would lower your position up here by $15, which now your average would be $325, because you now have two shares. Up here, 340, and you bought another one down here, we'll just say 310. And that difference is $30. So you have two shares, you would divide it, or you have an equal amount of shares, you would divide it by two, those two averages, and you just do the difference of $15. And so now your average is $325. So where does that put you at on this chart? It puts you right, yeah, it's kind of hard to hit without zooming in. So we'll just say right there, that's technically 325.15. Well, if you look over here, it had actually went up over, and for this day, July 10th, it hit a high of 327. So at this point, you would have been in the green if you would have just decided, heck, I'm selling right here, and let's just say you hit it at this top. You would have walked away with, just a couple dollars in the green. Now, not taking into consideration your commission fees, but still, that's better than taking a $30 loss. So that's the benefit of averaging down on a quality stock, and how it works on averaging down on a penny stock. And again, you might not take my advice on this, but trust me, if you don't take my advice on it, you'll learn the hard way. And learning the hard way is losing money. And it sucks losing money. It doesn't matter what amount of money it is, it sucks losing money, and you work too hard for that money. So, I appreciate you taking the time to watch this video. Please subscribe, please give me a thumbs up, and please share these videos with people. I would really appreciate it. It would help out a lot of people, and it'd help me out, because I really make my money day trading. I'm never going to sell a membership to anybody, and that's really the whole reason why I made this course, was because I got so sick and tired of seeing people on Twitter selling memberships. And the majority of these stock teachers that sell memberships, their courses are crap. I'm not saying all of them. There are some courses out there that are good, but the majority of them are crap. And there's a lot of free information on the internet, especially YouTube, that you can learn for free. Now the thing is, the reason why they can sell these courses is because they put it in order for you. They take the information out there that's free, they wrap it up, and they sell it to you in order. It is hard to find that, like I said, but here it is. I'm giving you a complete course for free to help you out. So, why not learn it? But again, I appreciate you taking your time to watch this. I will see you in the next one.